p.m. Central European Time, and I would like to proceed with planned time schedule. Let me welcome you on today's webinar dedicated to an update of Raiffeisen Sustainable Mix. The structure of the webinar is very simple. We will provide most important development on the company level at the beginning, in a brief as a brief summary, and then we will focus most of the time of the webinar on providing you an update in details of the fund Raiffeisen Sustainable Mix. Let me introduce the most important speaker of today's webinar. It's Thomas Moch and Pavelka. Thomas is a lead fund manager of the fund and lead manager of the equity part. Thomas is the head of development market equities team. He is in the business, in the industry more than 18 years, and since 2006 he's involved in managing of sustainable products. Paul is the lead fund manager of bond part. In his team, his responsibility lays in corporate, and he's also his experience in industry, in finance industry, investment industry, is around 20 years. He's also part of the sustainability team, focusing on infrastructure. And my name is Martina Rigatti. I work in Central Eastern European team, and I will lead you through this webinar. Let me mention, if you have questions, please post them in the chat. We will handle them either during the webinar or afterwards. Now, at this stage, I will switch off my camera and I will focus on providing you the most important development on the company level. Raiffeisen Capital Management is a leading asset manager in Austria with assets under management around 40 billion euro and market share slightly about 24%. We were one of the pioneers in the field of sustainability, and currently more than half of our assets, exactly 51%, lays or is invested in sustainable products, be it funds, be it mandates, be it advisories. On the chart below left, you see the development of the sustainable assets in our company from 2018 till 2022, and you see impressive development from 3 billion to 20.5 billion. This is a result of two facts. One is this transformation of our product range into sustainability products. And on other hand, as a second fact, here we can also see raising or growing demand for sustainable products. In the window on right side up, you can see several logos. Just briefly to mention, we are a member of several associations. In German-speaking countries, it's well-known Forum for Nachhaltige Geldanlage in German language. In Italy, we are a member of Forum per la Finanza Sostenibile. We are also a signatory of several treaties. We were actually one of the first Austrian companies who signed Principle for Responsible Investment Treaty in 2013. We are very proud on that. Apart or next to the PRI treaty, we signed Carbon Disclosure and Montreal Carbon Pledge Treaty. But what we are especially proud on is the award from Scope, where we receive an award, Scope Award 2023, and we were named as the best asset manager in ESG complete product range for Austria. So we are very, very proud on this award. Our products receive many quality labels, received many certifications. Raiffeisen Sustainable Mix is not excluded for receiving such exclusive labels. Name it, be it Austrian environmental label, be it transparency label. We receive also globes from Morning Stars, and from already mentioned association, Forum für nachhaltige Geldanlage, Forum for Sustainable Investment, let's translate it in English. We regularly receive 3 stars, which means the highest quality in sustainable investment process. And by the way, last year, our company was the company which received the most 3 stars for its product. So we are also very proud on these 3 stars appreciation by FNG. Let me mention Raiffeisen Sustainable Mix with few facts, although many of you know this product very well. This is the multi-asset fund focusing on developed market with its portfolio globally diversified. The portfolio is invested with 50% in equities, in shares, and 50% in bonds. On the right side up, you can see the line which actually expresses the percentage, the level of exposure of those 2 mentioned asset classes in the period of 1 year. And as you can see, the level oscillates around 50%. As mentioned already, we focus on developed markets. We invest next to euro also in other foreign currencies, mostly US dollar. On the bond side, we invest in government bonds, corporate bonds of investment grades, but we are allowed to invest also in non-investment grades up to 3%. We focus on the range in terms of duration between 2 and 5, but Paul will come later in details into this figure. And our investment style is not focused on value nor on growth, so we call it or characterize ourselves as a blend investor. We, on equity side, we invest in mid-large caps. This means market capitalization more than $2 billion, And the risk profile of the fund actually didn't change. The level is on 3. But with respect of the change methodology, in accordance with PRIPS-KIT methodology, we are on the level 3. Maybe you remember in the past, the risk-return profile was defined by number 4. So now let's focus on the performance briefly. On this slide, you can see performance since 2014. This is actually the year when investment concept, the sustainable investment concept was implemented, although the fund has far longer track record. It was launched in 1996. And even though having in mind certain crises, be it 2016, be it recent COVID crisis 2020, or even pretty demanding year 2022, the fund achieved a cumulative performance of 51% growth and per annum very nice 5.14%. But at this stage, I would like to hand over to Thomas, who will actually lead you through or who will actually explain you more factors related to performance. Thomas, actually 2022 was very difficult year. The correlation between equities and bonds was very high. So I would be curious to listen your commentary of, on one hand, long-term performance, but with focus on 2022. The floor is yours, Thomas.
Well, Martina, thanks a lot for this introduction, and good afternoon to everybody on the call from me. Here on this slide, we have a table illustrating the performance of the last years, broken down by asset classes. And it's interesting to see that there were 2 years outstanding very positively, the years 2019 and 2021. In those years, we had a really strong equity performance and a positive fixed income contribution as well. And the year 2022 was the complete opposite. Equities and bonds both had a negative performance contribution. Well, maybe let's focus first on the equity part. Here, what were the topics that hurt the equity part most? Well, I'd say there was a really strong focus in the equity markets on valuation. We invest, maybe could you switch back to the slide, the previous slide? We invest mainly in quality stocks, and those stocks usually have characteristics like stable earnings, high ROEs, strong management skills, and also high sustainability agenda. And those quality stocks, they were sold heavily because of their higher valuation. In Q1 to Q3, so in the first 3 quarters of last year, Europe especially was under pressure, of course, because of the Ukraine war and also because of the unsecure energy supply. And US dollar had a very strong run against the euro at this time as well. Only in Q4 then the situation changed somehow. So we were able to catch up a little bit in this last quarter. Well, you know this portfolio, Raiffeisen Sustainable Mix, as the name already implicates, is a fund with a high sustainability approach, a strong sustainability approach. And sustainability topics were not in the spotlight in 2022. So we saw fossil energy, commodities, and also military goods dominating the markets and the equity performance. One point I would also like to make here is the extreme sector divergence. This we can see also on the next slide. Here I have illustrated the different GICS sectors in the MSCI World Index. And there is one sector really standing out here, a clear outperformer. That's the yellow line, the very top. That's fossil energy, so fossil energy sector. And with our sustainability agenda, we are not investing into this sector. On the opposite side, on the very bottom of the chart, you can see the sectors communication, consumer discretionaries, and also IT. Those sectors were the clear underperformance of last year. Also looking into maybe a style, the style characteristics, quality, as I mentioned beforehand, and also growth. Stocks were heavily under pressure the last year, and the value style had a good year in the last year. So again, valuation was very key in this time period. Yeah, but maybe I stop here for the equity part.
Yes, thank you, Thomas. So thank you for sharing us the main drivers of the performance in 2022. And I would like kindly to invite Paul to share with us what was the driver or what was behind the bond performance, bond part of the fund. Switching to a next slide.
Yeah, thank you, Martina.
Paul, 2022 was definitely not a good year for bonds.
That's true. I would be glad to speak about better figures, but yeah, 2022 was a year of extremes, especially on the bond side. So yeah, I would say here above all, remarkable was that nearly all asset classes fell 2022, and usually you could a bad equity year improve via bonds, as usually you have negative correlation. So that in such a scenario, bonds would go up, but not in 2022. So there was no place to hide. Neither within bonds, as you can see in this table, in this graph. So that the red bars show the performance of these asset classes. At the top, government bonds, and they sold off most in 2022. So they sold off more than corporates, and this is especially a drama, as it was a weak year for corporates. Why did government bonds fell more? Predominantly because they had longer duration. As you can see in the table, in the second column to the right, government bonds had a duration at the end of the year of about 7 years. At the beginning of 2022, they had maybe about 7.5 or even 8 years. So this came down with the increasing interest rates. Corporates had a little better performance than the long duration government bonds, as they had less duration. But yeah, the credit risk added some more minus, as you can see in the second red column bar, the excess returns. So the corporate bonds had less duration, but credit risk. And in sum, it was a little better than the long government bonds. So as I said, no place to hide. Yeah, this was predominantly due to the tightening of the central banks, and for sure also via the conflict in the Ukraine. In Q4 2022, the picture changed and spreads rallied a lot, as we see in the next, so that we could have a little better ending in 2022 as it seemed in the middle of the year. But let's first show to the top left the main asset classes, the yield of the top main asset classes in the fund. So we came in non-financials and quasi-sovereigns from nearly 0% or even lower to about 3% and 4% for non-financials respectively at the end of the year 2022. So unprecedented moves. Spreads to the right rose extremely. Here I have a longer time frame, it's 10 years, and you can see only once you had these aggressive levels for corporates. This was the COVID crisis, but just as I can remember, it was just 2 weeks, I would say. Yeah, now we had even more extreme levels, especially at the bottom with covered bonds, Pfandbriefe, and quasi-sovereigns. So we had a quite extreme year for yields, for spread products. But what I want to show with the right hand charts, we are still at levels which are a lot above the average of the last 10 years. So we have still here quite a lot of value to harvest in the fund, I would say, for bonds. And therefore, we are quite confident for the year 2023. So then the next slide would show the weightings and key figures of the bonds over time. Just give me a second. The gray line shows here in the left chart in the passage of time how in the fund, in the bond part of the fund, government bonds and government-related bonds, so SSAs, super sovereigns, and agencies, behaved from the weight in the fund. So that means government, super sovereigns and agencies are government near issues like, for example, EU or CADES, so European Union or CADES, the French health insurance. And the increasingly lower weightings of government bonds were mainly due to valuation issues, with currently below 10% of all bonds are government bonds. The rest of the gray line is SSAs, so SSAs went up. The increasingly higher weight of SSAs is due to their more attractive yields and risk-return characteristic. Government bonds are also quite low weighted, as we do not invest, for example, into French bonds due to negative criteria concerning nuclear power, or for example, US Treasury bonds, which are also excluded due to ESG reasons. These government bonds were mainly replaced by the increase in the green line. These are financials. and also covered bonds from financial issuers. The increase is also due to valuation reasons. Maybe too early 2021 and part of 2022. But now we enjoyed a very sharp rally in the fourth quarter in these assets to compensate partly for losses in earlier 2022. Interesting also the black line. This is the weight of the non-financials in the bond segment of the fund. We successfully reduced the weight here before the sell-off in the market 2022. Additionally, we were quite successful with the increase then again of the weight in the second half of 2022. Here, these addings could all be done at very, very interesting yield levels and therefore proved quite successful in the fourth quarter. So we could in some profit in the fourth quarter with the highest allocation to spread products within the last 3 years, as documented in the black and the green line. To the right, we see the duration in green and the yield of the bonds in black. And as you can see, we have a quite low duration in the fund. When you remember what I said at the beginning, so benchmarks, quite broad markets, governments had 7.5, for example. Credit corporates had at the beginning of 2022 5.5 to maybe partly 5.7 or so. So you see, we were always here quite conservative. So our strategic allocation, which we set up always at the beginning of the year, was low, and then also the tactical duration strategies even reduced this duration so that we had a quite low interest rate risk, or quite low, I would say lower than the market. The best would be zero duration risk, but nevertheless we could avoid some losses to the fund. Yeah, then maybe the next slide with the classification of the performance of the bonds in the context. To classify the performance of 2022 and the years before. Yeah, it was an extremely harsh year for the performance of the bonds in general, and also for our funds, for our fund. Via our strategies and the allocation in the fund, we could alleviate the pain here a little. As you can see in the table, we were able, nearly every comparison here to common benchmarks and market segments, the fund proved in comparison quite okay. Nevertheless, we faced a harsh minus at the end of the year. This, as I said, this could have only been avoided through further massive reduction in duration. Okay, then I would like to go to the next slide, relative performance drivers, to explain what was good, what was bad. Partly we already discussed. So good was strategic allocation, conservatively, and also tactically on the duration side via strategies. Strategies work as an overlay to the strategic allocation. They were also always on the short side. Then a third point is US dollar bond allocation of 10% of the fund volume. This helped as the dollar helped to get some, had a good performance, and also because of the higher yielding US dollar bonds. Negative side, I also want to mention, treasuries and bonds with short duration would have worked best. We, for example, avoid treasuries due to the negative criteria. Also France and all substitutions worked worse than the safe haven govies with the same maturities in such a crisis than spread products. And also our view that financials will work well in 2022 with rising interest rates. this proved wrong, as this asset class faced systemic fears due to inflation and the conflict in Ukraine and heavy issuance. And yeah, these technicals worked against us. In some, I would say, but all these negatives work hopefully as a good basis for success in 2023. So better yields through financials and swap correlated instruments. And this success already we had in the fourth quarter of 2022. And yeah.
Okay, Paul, so I understand, we understand. So the positive factor was strategic allocation, tactical reduction of duration. This helps definitely. And negative factors which influence actually performance in 2022 will be a good basis for 2023 because we saw raising yields. So let's focus now on the current positioning of the fund. If it's fine for you, of course.
Yeah, the current positioning is to the right. We have the weightings on slide. Maybe you could step back just a little to the top right. Yes, thank you. The asset classes in the bonds sections could also be taken. That we talk a little bit on how we allocate within the segments. So quite high allocation to non-financial corporate bonds and also corporate bond financials. So we are quite positive on the corporate sector in general in the medium term. We are also quite positive on covered bonds as they offer quite good and attractive yield premium to government bonds. And on the government bond side and the SSAs, we are mainly focused on SSAs as they have like covered bonds, better yields and risk return perspectives. Then maybe as you already had the next slide. Thank you, Martina. Yeah, investment structure. We are mainly invested in the 3 to 5 years segment. As you can see to the top left, this is also a factor as we see this as the most interesting part on the interest structure curve. As yeah, for example, if you invest in a 4-year German government bond, you get more yield than if you invest in 5 to 10 years bonds. So it's an inverse structure. It's quite yeah, it's quite rare, I would say. And in the United States, the interest rate curve is so inverse. You have to go back to the 1980s to have such an inverse interest rate structure, and therefore for us it makes simply sense to be more in this part. To the right, we are quite focused on quality. Quality also comes via allocation, for example, more to covered bonds instead of French government bonds. So this increases the rating as covered bonds are mostly AAA and France is, for example, AA. It increases the yield and therefore also makes sense for us in the medium term. Maybe positioning also can be seen on the largest bond positions. So we are here in the biggest positions come from the SSA side. For example, the European Union with 5.6%. Yeah, it makes we bought this EU bonds also because of ESG reasons. So
maybe you could provide also an example. Maybe at this point I can interrupt you slightly. Maybe
yeah.
You can also provide with some example of a single instrument, which as explanation of for the selection process.
Yeah.
This was one of the questions coming from investor.
Yeah, so I will maybe answer in short, and longer will then come from Thomas for the equity in the equity part. But
Okay.
I can take away some notes here. For example, the biggest corporate bond in the segment is Tenet, which is tenets, which you do not see here in the largest bond positions, because I think there is some mistake happened. So you can see there are a lot of European Union bonds. So we bought this as they are social bonds. They support the people who could be laid off in the COVID crisis, and therefore helped to keep them in the working system. So these are a lot of social bonds we have in the system. Yeah, here in this table, it's all SSAs. Maybe I take the biggest corporate bond position we have in the fund is Tenet. This is a Dutch company which is in the electricity business. Dutch bonds is a very important company in the context of energy transition. So they have the grid, electricity grid in Netherlands and in Germany. For example, they pay about 1.3% more than German or Dutch government bonds. Dutch state is the owner. Maybe there is a possible trigger that bonds rocket when maybe the German state steps in and gives another boost to the structure of the company. Yeah, and an example which then Thomas will provide is Schneider Electric. That's a company which we like from the ESG side, as well on the corporate side as also on the equity side. It's always a company where the bond prices are quite high, so we wait always for possibilities to get bonds cheaper. This was the case in January when they came to the market with two new issues where we participated. So Schneider Electric, mainly it's in nearly the same area like Tenet, so it's electricity, and that's the heart of the energy transition, and therefore makes sense in every ESG portfolio. But more to the process than from Thomas.
Okay, so Thomas will talk about Schneider Electric at the later stage. Paul,
Yeah.
you mentioned that actually negative influencing factors in 2022 will be a good basis for 2023. So if you do not want to comment any figure on this slide anymore, my question to you is, what can we expect in 2023? What could influence the bond part of fund portfolio in 2023?
Yeah, so for sure, the central banks will path the way where interest rates will go. And yeah, thank you for the slide you already put in. We see here interest rates in time lapse, how central banks already increased. To the left, the US Fed. US Fed is quite far in the cycle, just some small steps to 5%. This seems to be the ceiling. The market focuses quite some months now on this 5% mark. And then in the gray line, this is the projection taken out of market prices where interest rates will go in the future. And here the market prices on the US side to the left and also on the Euro side to the right. Prices quite fast interest rate drops in the future. We are not convinced that this will be the case. We think that core inflation will be more sticky, so that it's not possible for central banks to go down with rates so fast. And therefore, we have still also quite a conservative interest rate focus on, for example, longer duration bonds. So we are here still underweight, and I have a quite actual example. So as I said, we have strategic positioning and we have tactical positioning. And today, just before lunch, one of our most famous models went short duration from long. This is our macro model, which focuses on mainly three parts. One hand is inflation outlook, inflation pricing. Next is where PMIs go, so that means in general, where does the economy go? And third, the valuation of the bond market. And as the inflation expectations came down a little lately, and also PMIs, on the other hand, went up, so it was quite balanced. And so the third part of the model gave the effect to the short side. This was the valuation. So the model said the valuation is too expensive, sell bonds, and this was already executed before lunchtime. So yeah, quite actual information. So that means we are conservative and went even a little more conservative today. Yeah, this is maybe already, yeah, thank you for going to this slide. This was maybe a little taking away from infos from this slide. So this shows here how inflation is evolving. We think that core inflation through the strong labor market and the wage pressure will not come down as maybe expected from the market, and therefore also deposit rate from central banks will maybe stay higher for longer as the market thinks. So yeah, nevertheless, for sure, inflation will come down. As you can see to the right, in the US, we have already seen the peak in yellow, and in black, the Eurozone will also follow. But core inflation in the Eurozone, we haven't seen the high. This will come soon. But yeah, we think parts of the core inflation will stay more sticky as maybe the market thinks. So we are here more conservative. Yeah, maybe then to the last part on the next slide, corporate bonds. So as corporate bonds are biggest asset class in bonds, yeah, is this correct, or why do we say that, or we believe that corporates should be high weighted? We think, as you can see in the chart, fundamentals of corporates are still very, very solid. The leverage is solid, interest coverage is solid. These two figures maybe are better than in the last 10, 15 years, partly. What could be a burden for the market? This could for sure be a default cycle, a harsh default cycle. But we do not believe this default cycle will start strong, and also rating agencies at the bottom thinks the same. So in the blue lines at the bottom, you can see the expectations of Moody's in the baseline. It should stay in the middle of what was the last 10 years. But sure, we focus on maybe the extremist scenarios, or should keep it in mind that it could come worse, and therefore we stand here with finger on the keyboard to maybe reduce also allocation when we see the signs. But at the moment, we think it makes very much sense to be in corporates. Yeah, and in sum, I would say we have already this year 1.5% performance in credit, in bonds. We think that we can earn most of the yield of 4%, which the fund shows at the moment for this year. So 2023 should be much better year than we saw 2022, and I hope we will never see such a year again. So yeah, maybe with this infos, back to you, Martina. Yeah.
Thank you, Paul. It was very nice words. So thank you for the outlook related to bonds. So I would be curious now, Thomas, what factors can influence equity performance in 2023? So what's your outlook?
Oh, well, Martina, I've put together some charts to illustrate the most important topics from my point of view. I will start with the top left chart, and the question, can Europe outperform? Well, we have seen a massive outperformance of US versus Europe over the last, let's say, 15 years. This was mainly due to the different sector allocations. So we had this big tech companies in the US, and Europe was lagging behind. But now it seems this chart indicates there could be a turning point. So we saw in Q4 of last year, but also in January now, we saw Europe outperforming US. And well, let's see if this will be of a longer duration. For those of you who are not cannot remember when last time was that Europe outperformed the US, it was in the range of between 2003 and 2007. Europe had a strong outperformance versus US, so it is possible. Let's put it that way. Let's move on to the second chart here. It's the gas price. You can see the spike from last year, and you can also see there is a normalization down to the level of the year 2021 again. And this is very helpful, especially for European industrial companies, because the gas price is an important cost factor for those companies. Also, what's not in the chart here, but what might also be interesting, we saw this China reopening quite recently, and this could also be a rather supportive factor for Europe versus US, as there are more economic ties between Europe and China. The third chart, the right bottom side, illustrates the oil price and on the right hand side, exactly, the oil price and the move of the energy stocks. And you can see that those two lines move usually alongside each other, and it did this for quite a while. But in last autumn, we saw some kind of decoupling of those two lines. And well, it would be interesting to watch how long this decoupling can last. And finally, the gap will narrow, and we'll see in which direction it will narrow, because the black line that's moving down again is the oil price. And I'm not sure if the energy stocks can outperform or can perform so much better than the oil price movement in the future. Yeah. So this will be important, and will also have some implications on our portfolio, as we do not invest into those fossil energy stocks. And the final chart on the bottom left side is about the tech mega caps. And we see there in the last 10 years, or around 10 years, we saw a massive outperformance of those stocks. And this was driven by this above average growth we experienced in those tech companies. And well, let's see how the next years will go from a growth perspective. So in the years 21 to 24, we expect also a better growth of those tech companies versus S&P, for example, but not such an huge difference in those growth numbers. So a rather moderation of growth expectations for those stocks. And if the growth moderates, it will be interesting to watch if also the stock price movements will moderate somehow. Yeah, so this will also be important for our portfolio, as we are not too much invested in those mega cap tech companies. So we have no investment. Excuse me?
You mentioned perfect word, portfolio.
Yeah.
So this is for me a sign that I should share these slides, which you would like to maybe comment.
The keyword.
Yeah.
Okay, so yeah, here we have this the portfolio structure, the investment structure of the equity part, and looking into the currencies on the top left chart, it might look like we have a lot of US dollar in this portfolio. But if you compare it to a global equities benchmark, a global equities index, like MSCI World, for example, the US dollar share would be around 70%. So we have less US dollar than a comparable index, and we have more euro currency in our portfolio. But I would say we feel quite comfortable with this higher euro weight in this under these circumstances. Moving further to the sector level, to the sectors, you can see in the breakdown, IT, information technologies, is leading the sector allocation, followed by healthcare and industrials. IT, well, the slide before I mentioned the IT mega caps and the uncertain outlook there, but we are not too much invested in those IT mega caps. So we are not invested into Apple, we are not invested in Amazon. So we have other IT stocks that look very promising to us, and we also increased in the last month some IT stocks. We also increased some healthcare stocks and also in the industrial space. So we found there some interesting companies that had a D rating that got much cheaper during the course of last year. So we moved into those stocks. And finally, the largest equity positions. You can see a lot of well-known names here. Well, it's on purpose. We're investing in leading companies in their respective industries. So we have a feeling that those champions should work well also in the next year.
Okay, thank you, Thomas. Before we explain the investment process using an example of Schneider Electric, I would like to touch one topic, and this is the investment process. We are working on further development of our already solid investment process. We implemented or included teams on which we would like to focus on. And I would like to ask you, Thomas, maybe to share and explain a bit, to lead us through this path, so we can better understand what will be the new focus.
Of course. Thanks, Martina. Well, as you mentioned, we strive to enhance our processes constantly. And we already have this award-winning investment process. And we tried to enhance and to enrich this process a little bit. And the result of this enhancement is this. We call it the green path. Yeah? This process, this path, has a number of checkpoints. I would call it like this. Up until now, we focused more on this ESG company value. So this is the second checkpoint at the bottom left. Yeah, this was the core up until now. And now what we did also beforehand, we looked into sectors, and we also did engagement. So we did all these things already. Yeah, but what is now the enhancement? We do it now in a even more structured way, in a more structured approach. So you mentioned already the those working groups. Those are dedicated working groups focusing on specific future issues, on sectors, trying to get in-depth know-how on those issues and on those sectors. And this is the very first checkpoint here. Yeah? We call it here ESG sector assessment, future issues and policies. And what's very important in this context, we have here teams from very diverse teams from every asset management department. There's at least one colleague working here in each team, and also from the sustainability department, at least one member in each working group, so that we can share the knowledge very broadly over all the different asset management departments. Yeah. So this is the one enhancement is this sector working groups and thematic working groups, and the other one is the third checkpoint here. It's the engagement evaluation. Well, we already did engage with companies in the past, of course, yeah, but now we bundled those engagement activities within the sustainability office. And now we also evaluate those engagement efforts there. And all these three checkpoints, all these three values, then go into this, run into this ESG corporate indicator. That's in the middle here exactly. And this indicator gives us a better assessment of each issue we are looking at. And the fundamental analysis that is following afterwards in the green path, this one has not changed really. So we up to now we did a qualitative and quantitative analysis, and we are still doing this. And all together, putting together the ESG corporate indicator and the detailed fundamental analysis gives us a valuation for each company, for each issue. Yeah. And now, as Paul already indicated beforehand, I would like to give an example of one company, that is Schneider Electric. It's a French company that has two major segments. One being industry automation. It's about one quarter of the company, and 3/4 being energy management. And now moving to the first checkpoint, the future issues. We have there the topic of energy transition and decarbonization of industry that play a crucial role for the company. And the working groups of energy and the working group of infrastructure, both working groups assess this sector of energy transition and this topic of energy transition, and deem it very positive. So we assessed it very positively. And then moving further to the ESG company value, the company value is very positive. It's 89 points out of a 100-point scale. So this is also a very positive indication. And the engagement evaluation, well, we had several contacts with the company representatives over the last years. And we also voted at the AGM, the annual general meeting of the company, recently last year, and also supported all agenda points there. So the ESG corporate indicator gives us an yeah, exactly. You're pointing out the A, yeah. So that's why we the evaluation was very positive, because we had such a good company contact with the company, yeah. And the ESG corporate indicator then, as a result, is double plus 89 and the A. So this is very positive. And what's also
Thomas,
important,
may I ask you, what would be the minimum ESG corporate indicator to for a company to be chosen in the portfolio? I saw in previous slide 85, double plus and B. Is that correct? Can we see it as a minimum level?
No, the minimum level. Well, we have not such a definite minimum level, but usually the ESG company value should be above 50 to be an interesting investment. The future issues assessment should not be negative, I would say. So could be double plus, or even neutral in some ways, yeah. But should be not negative. And the engagement evaluation, this is a topic we try, of course, to be better and enhance. So if the engagement evaluation was an N, like no engagement evaluation, it's we as the fund managers have to start the engagement. This is an indicator that we should engage with the company. And if the engagement evaluation was rather weak or negative, it's also we as fund managers have to become active and engage with the company. So it's in our discretion to increase this engagement evaluation. Exactly. Does this answer your question?
Yes, thank you very much.
Okay, perfect. But what a few last sentence on the fundamental analysis. So we expect for the both segments of Schneider, we expect a growth, mid to high single-digit growth for those segments, and we also expect some slight margin expansion over the next years. And what's also interesting here, the supply chain issues, they have improved already. Here now the question is which valuation multiples might be appropriate for Schneider. We see Schneider having a slightly or being slightly cheaper than the peer group companies, and being around its average valuation multiples of the last 5 years. So it's from a financial perspective, it's okay. It's slightly attractive, and from an ESG perspective, it's very attractive. Yeah.
Okay, then thank you very much, both to Thomas and Paul, for providing us the analysis of 2022 and giving us an outlook for 2023. We still have some few minutes, so let me just briefly sum up. First, market, then positioning. So we will still closely watch the monetary policy of European Central Bank and Fed, although we do not expect any surprise there. We saw a peaking inflation in US already. We think we are ahead of peak in Europe. What we think, the core inflation will be more sticky, so we will position ourselves conservatively, focus on conservative interest rate focus and on duration of the bonds. We see from the equity side, we see the valuation of Europe is very interesting. So we will also position accordingly, and the stock picking definitely will be the most important source for Alpha. And at this point, I advise you or recommend you to search for more information about this product, but not only about this product, on our website, www.rcm-international.com, because this product is actually registered in many countries in Central Eastern Europe, which is, name it Croatia, name it Slovakia, Czech Republic, etc. Romania, Hungary, but it also serves as a master for feeder local fund, and there you find the information on the local website. So mentioning the feeder funds, these feeder funds exist in Croatia, in Slovakia, in Czech Republic, and also indirectly in Hungary. So as I do not see any question in chat at this moment, I would like to thank you for your attention, for staying with us a full hour. and wish you a great day and hope to see you at the next Fund Manager update. Thank you.